Morning, Memphis. That's pretty good. I'll take that for Tuesday morning. So, welcome. I'm Ted Townsend, President and CEO of your Greater Memphis Chamber, and we're so grateful for you being here. Thank you for coming out this morning and investing in the work of your chamber. It's so critical. And this is our first signature event of the year, and tomorrow we are going to Nashville, as we call it, MEM to Nash, where we absolutely take over Nashville, and we love doing that, right? Come on. A bunch of Nashville fans. You are in Memphis, M's up. All right. Most importantly, I want to thank you for your investment of time and leadership. This week is a perfect example of just that. As I mentioned, several of you in this room, by show of hands, how many of you are about to tackle I-40 and head east to Nashville with us? Yeah. So thank you for that. Why that is important is it because it harnesses the collective voice of business, where we impress upon Nashville that we expect co-investment and policy partners so that businesses can thrive here in Memphis. Last year I stood before you. I had just taken the reins as president and CEO, and in that time we've made great strides. But what I am most proud of is that our team produced our first strategic growth plan in more than 20 years. For my colleagues at the Greater Memphis Chamber, many of them are standing up already, but please stand up if you're not, and everybody in the audience recognize this amazing team at the Chamber. It's an award-winning team. We are nationally recognized for the work that we do, and it's only possible because you empower that work. But that strategic plan, that plan is bold. It's very bold, and we want it that way. But the goals that we've set are attainable. They're driven by data, just as your businesses are driven by data. The plan is driven by outcomes. We are oriented to better outcomes. And we're pointing at a greater Memphis that is more prosperous for all of us. It's the work that drives our Prosper Memphis 2030, which is our North Star. Prosper Memphis 2030 is an ambitious plan that will add 700 advanced industry companies to our economy. Those companies will create 50,000 high-quality jobs, and we will award 20,000 STEM degrees and credentials by the end of 2030 every year. So today you will hear from our Executive Director of the Greater Memphis Economic Research Group, Tecora Murray. Tecora will preview some of the data that drives Prosper Memphis 2030, and one of the data points she will highlight is that Memphis is number one, okay? Number one amongst our peer cities in advanced industry job growth. Yeah. So when I say we're going to bring 700 advanced industry companies here, and the fact that already, in the wake of a pandemic, we're number one in advanced industry job growth among our peer cities, that is the state of your economy to come. So, these are critical and high-quality jobs that are coming. And you know, when we did our first MEM Measures report, we were only number one in one of those economic indicators, just one. And you'll hear about that again because we maintained that number one. But now we have two indicators where we're number one. And 70% of those indicators are either improving or sustaining. But we still have a lot of last place indicators. And that is the rub. That is what inspires us and motivates us as a chamber to get up every day and serve you, the business community. Because we expect prosperity for all. Shameless plug. We would love for you to visit our new website, memphischamber.com. Same URL, but a different look. So if you haven't visited it in a while, please do so. And you can download all of our industry sector reports for free. That doesn't get applause for free. What? I mean, come on. A lot of work went into those reports that Tecora led, and it's incredible the breadth of the data that's available to this business community. And speaking of data-driven, there is no one better than our keynote speaker, David Waddell. David, thank you. Thank you for being here, for all that you do for this chamber. He served on our board for years and years and provided us incredible leadership, and we are so very grateful for him and all that he does for Memphis. Before I invite our sponsor to the stage, please allow me to recognize two important leaders in our organization, our chairman of the board, Greg Duckett, who is already on I-40 heading to Nashville, and chairman of the Chairman's Circle, Bill Donovan. Is Bill here this morning? He's also headed to Nashville. I promise we'll bring him back. We will. So thanks to both of those gentlemen. Now, it is my distinct pleasure to introduce our sponsor for today's event, Eustace Corrigan Jr. He's a good friend of mine. He is the Senior Managing Director for the Memphis office of CBiz. Eustace.
Thank you, Ted. Good morning, everyone. It's a privilege to stand before you today at the 2024 State of the Economy Address presented by the Greater Memphis Chamber, as we gather to gain insights on the economic landscape from my good friend David Waddell. I'd like to take a moment to introduce you to my firm, CBiz MEM, as we are honored to be your presented sponsor this morning. CBiz is a national leader providing top-tier accounting, tax, and advisory services with more than 120 offices across the U.S. and 6,500 employees. We bring national caliber expertise, combining it with the personalized service you'd expect from a local partner. Our commitment to Memphis goes beyond just doing business. It's about being part of the community, understanding its unique needs, and working alongside our clients to help them achieve their goals. Memphis is not just a location on the map for us. It's a place we call home, where we aim to make a meaningful difference in the lives of the businesses and individuals we serve. What sets us apart is not just the breadth of our services, but the depth of our solutions. We understand that each client's needs are unique, and we pride ourselves on delivering customized, innovative solutions that address those specific challenges and opportunities. Whether you're a growing business, a large organization, or an individual needing financial guidance, our team is equipped with the expertise and passion to help you navigate the complexities of today's economic environment. As we look forward to today's discussions and insights from David, we're reminded of the importance of adaptability, foresight, and strategic planning in achieving economic success. These principles guide us at CBiz as we strive to be a service provider, a trusted advisor, and a partner in your success. Before I conclude, I must acknowledge the exceptional efforts of the Greater Memphis Chamber and the Chairman's Circle. Having been closely involved with the Chairman's Circle since its inception, I have witnessed firsthand the fervent and dedicated efforts put forth by this group. All driven by a shared passion for enhancing the vibrant city of Memphis. As a co-chair of the Chairman's Circle, I am more committed than ever to elevate my contributions and work collaboratively towards our common goal of making Memphis an even greater place to live, work, and thrive. Thank you for the opportunity to be a part of this vital conversation. Now I'll turn it over to Michael Hooks, who will introduce our speakers.
Good morning, and thank you to Eustace and Ted. Townsend. Ted is definitely one of my favorite, I'd say my second favorite CEO. I'm Michael Hooks Jr., I'm CEO of All World Project Management. So you can imagine. Thank you, Eustace, for your support today. We also are proud investors. All World has invested in the Chairman's Circle for the last several years, and we believe in the power of unification. I look across this room and I see so many of my friends who are leading organizations that support families like ours. And whether you're a Fortune 500 organization or a small business, we're all in the same boat that we need to keep afloat. Amen? I have the distinct pleasure today to introduce two speakers. First, you will learn from Tecora Murray, who is the Executive Director of the Greater Memphis Economic Research Group. Tecora is quite simply one of the best researchers in the state of Tennessee. Prior to joining the Chamber team, she served as the research manager for the Center for Economic Research in Tennessee at the Tennessee Department of Economic and Community Development. Tecora believes strongly that the data, like we should if we're all running successful organization, is the foundation of building a greater Memphis. Immediately following Tecora, you will hear from our keynote speaker and my friend David Waddell. David is Waddell Associates fearless leader, is that right? Is that a typo? Okay, fearless leader as the firm's, again, CEO, maybe my third favorite, CEO and Chief Investment Strategist. David pulls from over 20 years of experience, combines both macroeconomic forecasting, macro market analysis, and macro risk assessments to design portfolio strategies for clients utilizing public market securities worldwide. That was a lot. You're going to have to break that down to me. He has been featured as a global economics and investment expert in national and global media outlets such as CBNC, Bloomberg, Business Insider, and Barron's. We will begin with Mr. Tecora Murray. Thank you.
Good morning. How's everybody doing this morning? Okay, oh, I didn't hear that. You guys were loud for Ted, but where's the energy at for me? Thank you. Well, thank you all for joining us this morning, and thank you, Ted and Michael, for the introduction. I am excited to share some of the awesome metrics that we have found through some intense research through our MEM Measures report. So as the, I'm still trying to learn how to say executive director because I said research manager for so many years. As the executive director of the Greater Memphis Economic Research Group, I have a lot of time to do deep dives into data that helps shape the understanding the Memphis economy. So with that, I am super excited to talk about what we found. There we go. So anyways, this report, before we dive into talking about GRP, this report basically looks at key indicators that measure the economic health of the Memphis economy. And in this report, we compare ourselves, or we measure ourselves against our peer metropolitan areas with populations of 1 million or more, similar to the Memphis region. So one of the awesome things that we get to celebrate is our economic vitality. Our growth regional product increased 5.9% between 2020 and 2021. This growth reflects our resilient and dynamic economy. It also showcases our strengths in our industry reports that continue to drive prosperity, even during a time of recovery from the COVID pandemic. However, also with our analysis, it highlights areas where we must focus our efforts on improvement. So the Gini coefficient, which is a measure of income inequality, it saw a slight increase from 0.491 in 2019 to 0.493 in 2021. So this small increase signifies that there's a growing disparity in income distribution among our residents here in the region. Also, while the median household income grew to $56,926, reflecting a 5.6% increase from 2020 to 2021. It still trails behind the national median by almost $14,000. So these figures remind us of the ongoing challenge to bridge the economic gap and ensure prosperity reaches everyone in our community. So this leads us to our Prosper Memphis 2030 initiative, which embodies this commitment. By aiming to attract 700 new advanced industry companies and create 50,000 high-quality net new jobs, we are working hard to ensure a future where prosperity is accessible for everyone in the Memphis region. Our vision is accommodated by strategic objectives designed to sustain 2% or more annual growth in regional GDP, highlighting the entrepreneurial spirit of the Memphis economy. Yet, as we dive deeper into our economic indicators, challenges in housing affordability and food security are emerging. Over 29% of our population, spends more than 30% on housing, placing us behind our peer metropolitan areas. As you see, we rank 10th against New Orleans, Nashville, Milwaukee, Oklahoma, Louisville, Birmingham, Indianapolis, Kansas City, and St. Louis, who ranks number one. Also, food insecurity remains a pressing issue, with 15.1% of our population facing challenges in accessing nutritious food consistently. But on a brighter note, Memphis has much to celebrate in the economic arena. In 2021, like Ted said, we ranked not only first among our peers in job growth within advanced industries, but we also saw a significant 15.3% increase in STEM jobs over the past 5 years. That's something to celebrate. I don't hear any clapping. That's good. So this reinforces our strategic focus on creating high-quality employment opportunities in our area. However, as we transition into the next topic, it's clear that educational attainment in STEM fields presents an opportunity for improvement. With only 7.4% of our population attaining an associate's degree and 29.8% attaining a bachelor's or higher, shows the need to invest in strategies that highlight clear career pathways. And the reason why I emphasize on clear is because it's hard to navigate from getting a degree into finding your way into a STEM job. So, we must invest in strategies that highlight clear career pathways into STEM occupations. Such investment is crucial to maintain our economic strength and competitiveness. So, after we listen to David Waddell today, let us reflect on these insights that we learn to guide our actions towards a prosperous economy. Our data shows the critical need for targeted interventions to bridge economic disparities, bolster educational attainment, and ensure that prosperity we seek is accessible for everyone in our community, every corner of our community. Thank you for your dedication to our community's future, and let's continue to work together, guided by data, and make Memphis greater. Thank you.
One, two, three, excellent. Do I have any Swifties in the house? I saw Christopher Lamberson. Where are you? I know you're a Swiftie. All right, I'm going to set a clock here because while this may be my favorite thing to do, it may not be your favorite thing to do. That's right, I'm the problem. All right, so I need a clicker and I'm going to wander down here because I can't see the slides otherwise. So are we good? Rules of engagement? All right. Here, let me say this real quick. The most important economic resource in any city is talent. If you have a lot of talent, you have a lot of growth, right? So I have been a member of the Chamber's board for many moons. And I've also been a member of the Chairman's Circle for 10 years. And I've got my CFO somewhere in the audience, and so I know he's puckered up right now. Sorry about that. It's expensive. Yeah, but that's the thing, it's worth it. But the reason it's worth it is because the staff of the Chamber is the most talented I have seen over my entire experience within the Chamber in Memphis, Tennessee. So if there's hope for prosperity in Memphis, it starts with the talent that's within the Chamber. So great job building that team, and good job, Ted, for leadership. All right, so for this, every year I take a week and I climb into a cave and I go mining. Right? I read everything I can possibly read, and I think as deeply as I possibly can around what's going to happen in the year ahead. And while I was in my cave mining this past year, I had this song replaying in my head the entire time, Mean by Taylor Swift. Why are they so mean? Why are they so mean? And I thought, well, why in the hell am I thinking, why are they so mean all the time? So number one, it could be that it was my daughter Sailor's favorite song when she was little, and that just made me super happy. Number two, it could have been that everywhere I look, I see Taylor Swift. I don't know if y'all have this. Like the whole, we live in a Swiftiverse, I think, at this point. And every activity is Swiftable. And so maybe it was that. Or maybe it's the fact that after 4 years of COVID craziness, I just wish that economics, politics, and markets would calm down. Right? Like it's been exhausting over the last 4 years to be a forecaster, to be an investor, and I know you all are exhausted by it as well. And wouldn't it feel extraordinary if we just went back to average? I mean, how would average feel? I mean, wouldn't it be kind if we could reclaim the mean? Right? And so that's what sort of illuminated in my head and drove the path that we're going to walk down together. But before I go forward into this, two things. One, read your disclosures. So for the lawyers in the room, there it is. All right. Now, this time last year, I didn't give the Outlook presentation this time last year. I think Drury did. And he was right because he said no recession. So I don't know if he's in the room, but he was right about that. So my outlook going into 2023 was titled, The Power of Perspective, What Could Possibly Go Right? And the reason I titled it that is I'd never seen the higher degree of pessimism going into a year than I ever saw at the end of 2022. This is a chart, and for those of you who can't see in the back, all of this and more is on our website at waddellassociates.com or wealthstrategist.com. And so there's an hour-long version of this. I'm going to run through it, but you'll have all the slides there. So sorry for the small script. But all the economists surveyed going into the end of 2022, 45% of them said, we're just going to have a recession, right? Well, that was the highest that had ever been, going back to records being kept. Strategists, people like me on Wall Street, normally say market's going to rise 5 to 10% in any given year. They think that's the mean. We'll challenge that. Last year, they said, actually, the markets are going to fall in 2023. Now, they don't typically do that, and they hadn't in the last 25 years. Which is why those of you in the audience as retail investors, if you were polled, only 25% of you were optimistic. Only 25% were bullish. Only 25% thought the market would be higher a year later. And that's the reason I got wildly optimistic. Because if you look at the data, and I do love the data, nothing pleases us more than pessimism. Historically, when only 25% of you all, us collectively, feel optimistic, the market is 20% higher a year later. In fact, it's not optimism that scares us, it's pessimism, right? Or pessimism that scares us, it's optimism, because when 50% of investors are bullish, the market's typically down 2% over the next 12 months. And our contrarian instincts paid off last year. As stocks advanced, call it 20% plus, I'm highlighting here the All-Cap World Index, which covers all the stocks across the globe. That was up 23%. By the way, bonds are back. Bonds were up 5% last year. And even gold, for those of you who love to rub your gold, you gold bugs, even that was up 13% last year. The only thing that was down in a major category, which jury's not in the room, is it? Because he's in this space, was commodities, which is actually a good thing, right? Because it's an input to the economy, it's an input to earnings, and so it's okay for that index to get down. So basically, it was a fantastic year. Fundamentally, nothing happened. The 10-year Treasury bond, while it bounced around, started the year and ended the year at the same level. The U.S. dollar index, which bounced around, started the year and ended the year at the same level. S&P 500 earnings, even though they bounced around, started the year basically at the same level. What changed last year was all sentiment, right? So you started the year at 25% bullish, you ended the year at 51% bullish. So if sentiment rose 26%, which is exactly how much the stock market rose. So last year was all about sentiment. So here's your master's class in investing, looking at last year. When it comes to being a successful investor, you must master the power of perspective. And what I mean by that is when the whole world gets pessimistic, I want you to remember this: pessimism pays, okay? All right, so that's last year. There and end is the lesson. All right, now let's take a look at this year, and to figure out where we're going, we got to do a swift survey of the economics, politics, and markets for 2024. All right, so first let's level set. Before we start talking about our economic search for meaning, we got to do a little bit of statistics. Now, you may recognize this as Taylor Swift. You may also recognize this as a traditional bell curve, right, which is a range of outcomes. And in the center of that, you have the average, which is the mean, and this is going to be the spine of our presentation. So let's get familiar. So you'll recall from your high school statistics class that you failed. 70% of the outcomes occur between 1 and 2 standard deviations from the mean, right? Nod your head. Yeah, we remember this. Within 2 standard deviations, between 1 and 2 is another 26% of outcomes, and then at the fringes of the bell curve is about 4% of total outcomes, right? Since 2020, we've had 100 million COVID cases, and that's led to masking, that's led to millions of deaths, and that's led to inextricable outcomes like the fact that we had 15% unemployment one year, and then the next year we had 3.5% unemployment. We had a 5.5% 10-year U.S. Treasury yield. Then we had a 5% 10-year Treasury yield. We had no inflation, then we had 9% inflation. We had a 0% overnight interest rate. The Fed funds was 0, and then it went to 5.5%. We had political riots within our cities. And then we had political riots within our capital. We had the bond market down 13%, which was historically a train wreck. And then we had the bond market up 6% short after. Stocks fell 40% into COVID, and then they rallied about 120% plus coming out of COVID. So it's been a wild ride. And clearly, Taylor is haunted by it. So the question is, can we get off this ride? Well, let's start with a swift survey of the economy. All right, let's go back to our bell curve. There are 3 potential outcomes that we need to discount looking at 2024. Are we going to have a hard landing? What does that mean? GDP falls, it goes negative, also known as a recession. And we have inflation that disinflates down below 2%. That would mean unemployment rises, stock market goes down, hard landing, no fun. What about no landing? Well, what if the GDP keeps roaring and inflation stays above 2.5%? Well, that may seem favorable. In reality, that would require the Fed to get more aggressive, more likely break something, and put us back in a hard landing. So where we want to be in 2024 is right here in the mean. We want a soft landing where GDP is somewhere between 0 and 2%, and inflation comes down towards the Fed's target somewhere to 2.5%. So that's the goal. Let's see if we can get there. Well, inflation is going to hold the key to everything, right? So if you have one indicator that you're taking on your deserted island, take the inflation data with you, and you'll know what's going on with the world. So this is the Fed's preferred inflation measure, the PCE inflation, excluding food and energy, going back to 1960, I think. And as you can see, in December, we got a January number that was a tick higher than this, but I didn't have time to update the slides. So for those of you who are, data hogs, I know. All right. But the Fed's target is 2%. So even though we're back down below 3%, more or less, the target's 2%. Inflation's still too high. That's bad news. Here's the good news. When you unpack inflation and you say, what's going on within that number? First of all, core goods. How many of y'all ordered stuff on Amazon during COVID? Yeah. And those of you not raising your hands are lying. The middle of the night when you're on the Instagram and you're like, I do need that koozie, Yeah, you know what I'm saying. So anyway, core goods went through the roof because we had supply shortages. We had this stay-at-home COVID appetite. But now that's come back down as the shortages have broadened and as the supply chains have opened up. So core goods back to pre-pandemic levels. Core services, this is revenge travel, right? We had a lot of pent-up demand. You wanted to go to restaurants. That's been happening. The unfortunate thing is there's been a shortage of labor, so prices have gone up, blah, blah, blah. So core services remain elevated, but they're trending in the right direction. What about shelter? Jimmy and I had a great conversation earlier. Jimmy, this is your section. You ready? So what about shelter? Shelter is 22% of this measure. It's 40% of the CPI measure, which is normally what you hear on TV. That's a lot. So what goes on with shelter matters. Well, here's the thing. The way the Fed measures shelter inflation, the inflation of your house and your apartment, is flawed, and it lags. If we look at more recent data on shelter inflation using the Zillow Observable Rent Index, we're actually back down to pre-pandemic levels. And the Fed knows this. In fact, if you take shelter out of my inflation calculation, inflation right now is 2.2%. That's very close to the Fed's target, right? Now, that's kept the Fed from raising rates further, but they haven't started cutting rates yet. Additionally, they are mopping up, call it $100 billion a month in liquidity through their quantitative tightening program. So the Fed remains mean. They're still tight. And so let's take a moment and think about where we are in the chronology of Fed tightening. So there's Taylor. She's on red. And the slides look funky on this computer, but you'll survive. Again, go to the website. You can get this and many more. All right, so the Fed policy stance past COVID was we got to stimulate this thing as much as humanly possible. How do we do that? We take interest rates to zero. We print a lot of money, right? That was very accommodative policy, and we made a bunch of money because of it. And so the green area is the accommodative policy of the Fed, which maxed out about March of 2022. That's when they started raising interest rates. By the end of 2022, they'd raised interest rates far enough to put us in restrictive policy, right? They're trying to rein economic activity in. So we were in restrictive policy for all of 2023, which is why the majority of economists said we're going into recession, because there's your restrictive policy. Well, let's talk a little bit about long and variable lags. This is an economic term people throw around. With the Fed's tight, then it's going to incite a recession, and it happens with long and variable lags. Well, here's the path of the economy while they were loose. So while the economy was supported by the Fed with accommodative policy, on average quarterly, we were going at 3.25%. Then they got tight. Here's your restrictive policy, and we're going at 3% on average. In fact, the economy accelerated into the third and fourth quarter of last year. Maybe it had something to do with the Eras Tour. How many of y'all went to the Eras Tour? Come on now. Really? Well, there are still opportunities to go, and your economy could use your support. So she added about $5 billion in economic activity, which is a lot, in the third and fourth quarter. So go Taylor. Point is, though, the economy grew 3% when they were restrictive, 3.25% when they were accommodative. What gives? Shouldn't we be in recession? All right. Let's talk about the economy and answer that question. So 68% of the economy is consumption. That's you going out and buying goods and services. 17.8% of the economy is basically business spending, the stuff that we do here on a daily basis. 17.5% is government spending, which is just redistribution of your tax revenues. And then Richard's not here, he's in the Middle East, but I threw this in for him. So 2.8% of the economy is actually a deduction because we run a trade deficit. I'll talk briefly about that, it's actually getting better, but there's a FedEx plane carrying goods, I guess, into the United States. All right, let's talk a bit about the state of the consumer, all of us. So first of all, I look at, the balance sheet. What is happening with household net worth? The reality is it's at an all-time high, right? I mean, it was growing smartly up until COVID, and then we got all this stimulus money, and then we got housing inflation, we got stock market inflation, so we got asset inflation. The pace of net worth growth in the United States went up by a factor of 50%, I think, from where it was before. So we're at all-time highs in terms of net worth. What about incomes? Well, here's real disposable personal income. This is the stuff after tax, after inflation that you can spend. Right now, your incomes are growing about 4% on an annualized basis in real terms compared to 2% pre-pandemic. So you got plenty of income to spend, times are good. What about debt? I see things on the news, credit cards, blah, blah, blah. Well, no, we've got plenty of debt capacity. This is what I think about how much debt capacity you have. I look at how much does it cost to pay all of your debt service. And right now it costs you about 10% of your income. That number was well over 13% before the Great Financial Crisis, and that number is actually below where we were pre-pandemic. So consumers have plenty of credit capacity, and they also have plenty of job opportunities, right? So this is the number of jobs open per unemployed worker, which right now is 1.4. So everybody looking for a job has 1.4 opportunities. So plenty of jobs available. Consumers in good shape. Here's the bad news, right? These are all of the recession periods going back to 1960 and the amount of drawdown in GDP. As you can see, the historical average is when we go into recession, it deducts about 1.7% from the total economy. Here's what consumers do during that period. They don't really care, So sometimes they spend more, sometimes they spend less. On average, they actually spend more. So a lot of folks on TV will say, well, we're good because the consumer's good. That is a terrible early warning indicator of recession because consumers will spend every dime you give them. What about businesses? Businesses are not recession-proof. Perry and I have been through a few recessions, and it requires some conversation. And so you end up shrinking your spending as a business, mostly in real time. It's pretty correlated, but you can see the historical average drawdown in GDP is 1.7%. Business spending during those periods down 1.6%. So businesses are very sensitive to the economic environment. Consumers, not so much. Well, right now, business spending is healthy. Right? So we grew business spending 4% year over year. It didn't hurt that Bidenomics gave us the IRA Act, the CHIPS Act, and a bunch of other sort of programs. Smart manufacturing in the US has gone up like 100%, and we're building a bunch of factories and stuff like that. Yes, it's government money, and I know that causes some heartburn, and we can deal with that in Q&A. But for now, it's supportive of business spending across the economy. Unfortunately, business spending is really not a good leading indicator. It's a very good coincident indicator. So this is what's happening in business spending 2 quarters prior to recession. And you can see, historically, businesses are spending money right up until the moment of the collapse. So where are you going to look for to find an early warning signal of recession? It's not consumers, right, because they don't care. It's not businesses, because yes, they stopped spending, but only once the recession started. It's housing, okay? So housing is the best early warning signal of a potential upcoming recession. So here's housing activity right now. There was a divot in 2023, multitude of reasons for that, inflation, labor shortages. As Jimmy told me in the lobby, it's because we had done so much before 2023. As you can see, that huge spike. So it was soft in 2023, which was another reason economists thought, we're going into recession. But we quickly turned the corner on that. And so now housing is actually accelerating in the United States. And there are a couple of reasons I think why. First of all, on average, those of you in the room have a mortgage, it's 3.7%. You go get a brand new one, it's 7%, which effectively locks you into your house. So perversely, the Fed raised interest rates so quickly, it actually turned out to be economic stimulus because we only have 1 million houses on offer that are old homes relative to the 2 million we had pre-pandemic. And so if Taylor wants to move to the big old city, she's going to have to buy a new house. And in fact, in the third quarter, 31% of all transactions were new houses relative to, call it, the 15% pre-pandemic. And new houses, if you think about it, you got to hire people, you got to buy wood, you got to hammer and stuff. Like, it's stuff, right? It's economics. And so housing starts, yes, that's Mick Jagger for those of you who can't see. Housing starts, start me up. So right now we're seeing housing starts accelerate. We got a cold number for January, but that's just because it was cold. So there seems to be lift in the housing market, specifically among new starts, which is good for the economy. So on the economics, 2024, we are still growing. I do not see a recession. In terms of net exports, that trade deficit actually is declining a little bit. That is supportive as you buy less things late at night on the Instagram. In terms of consumption, it's growing, but it's slowing. Real wages are coming down a little bit. And that's fine, it's natural, we're reverting to the mean, but that should slow expenses or consumption a little bit. In terms of business spending, it's still growing at pace, no real signs of disruption there. By the way, they have the same credit thing where they pay 3.5% on their debt basically in a world of 5% plus, and so they got smart and they locked in a lot of capital at low rates. In terms of government spending, it's neutral, it's been contributing, but we've got, an election. And we also have a debt ceiling. And so there's some natural forces that are sort of sequestering some of that spending. And then housing is accelerating. So if we look at our estimate for what we expect of GDP growth in 2024, and you'll see it sort of dip and grow. Nobody really knows how things are going to bob and weave on a quarterly basis, and so I just sort of averaged it across. So I'm feeling like it's 2%, and Taylor's, she doesn't know about you, but she's feeling like it's 2%. So I think we're in a 2% world, which is good, and I think meets the mandate of the chamber too, which is nice. All right, so it's a soft landing. So yes, Taylor, it's going to be all right. But you should be asking a question if you're somebody like me, why haven't we fallen hard? We've been in this negative, policy, era here since the end of 2022, and so why haven't we recessed? Where are those long-term policies? I mean, we got leading economic indicators that are now negative, and they've been negative for, historically long time. We've got a shrinking money supply, by the way. We have wars all over the place, apparently. We've got negative credit growth right now across the entire banking system. We've got inverted yield curves, which traditionally foreshadows recession. And then we got these pesky elections bedeviling everybody. So with all this stuff going on, why the heck aren't we in recession? Well, long and variable lags, in my judgment, do not cause recessions. What causes recessions is crisis. That's what causes recessions. And usually what instigates a crisis is the inversion of the yield curve. A little bit of economics. That means banks are paying a lot on deposits, not making a lot on loans, and so they don't really want to make loans, right? And the Fed does that on purpose, and it slows down credit within the economy. And when credit shrinks, the economy shrinks, inflation comes down, and they restart the story. So normally when you see the inversion, you have a crisis. So in the 90s, you saw the inversion, you had the S&L crisis. In 1998, you had the Asian currency crisis, which ricocheted all the way into Manhattan with long-term capital management. It blew up. Fed had to step in. Crisis. The tech wreck in 2000, things were wildly overvalued. Crisis. Bear Stearns failed, right? Back in 2008, there was a great financial crisis. Y'all remember that? COVID. There was a bit of a crisis setting up. We actually hedged at the end of 2019 our portfolios because there was a liquidity crisis brewing. Fed went and mopped that up, then COVID took it down. So not a financial crisis, but a crisis nonetheless. And so now we've been in inversion for quite a long time and haven't had a crisis. Or have we? In 2023, we had 5 banks fail. That doesn't sound like a whole lot. We had 157 banks fail back in 2010. So no crisis here until you look at the amount of assets on the books at those banks. So last year, the banks that failed, the five, accounted for $549 billion in total assets, compared with 375 in the year of the greatest bank failures in 2008. We had a crisis. There was a financial crisis. But the Fed saved us. Because what they did was they opened up the taps and made an enormous amount of credit available to the banking system. How much credit? About twice what they made available during the great financial crisis. So the Fed ultimately saved us. We had a crisis. Y'all just missed it because the Fed fixed it. So are we out of the woods yet? Asked Taylor. I would say no. Going back to 2019, there's another crisis I'm a little worried about, which is that the Fed's quantitative tightening program is deducting $110 billion out of the system every month, and that's starting to lead to some tightness there. Begging the question, is the Fed aware of this? Are they thinking about doing anything about it? Good news. There's Jerome. And the Fed minute said it would be appropriate for the committee to begin to discuss the technical factors that would guide a decision to slow the pace of runoff. Translation, yeah, we know. And so they're either going to slow down the pace of tightening or they're going to extinguish the tightening altogether. So that's good. Also remember, yes, that's Taylor Swift in a Philadelphia Eagles jersey, go Birds, because before Travis there was Jason, and she's from Philadelphia. As an Eagles fan, I had to do that. So she's taking it easy because the Fed's taking it easy. Right now, they're pegged at 5 and call it 5.38 is the effective rate on the overnight rate. But they told us they're going to take it to 4.6 by the end of this year. They're going to take it to 3.6 by the end of next year. And they told us, by the way, you had to read the minutes, which I do, how fast they're going to do it. So Powell said, I think the expectation would be that the real rate is declining as we move forward. For the real rate to decline, that means they have to cut interest rates faster than inflation is falling. So that's good news. Now, back in the 1970s, we had this second bout with inflation, right? And everybody talks about we're going to have this second bout of inflation again. It's the 1970s. Well, what caused that was energy crisis. We had the Iran oil embargo. We had a bunch of bad policies. And so are we going to have an energy crisis? Is that the crisis that's going to bedevil this economy? Well, here's European natural gas prices. They spiked during that conflict. They're now back down to where they were pre-pandemic. So crisis averted. New supply lines, warmer winters, whatever the case. Well, what about Israel versus Hamas, right? That's a conflict that could instigate World War III, I hear. It could also roil the oil markets. The reality is oil prices are back down to where they were before that invasion. So we are producing almost like 14 million barrels a day in the United States of America, which is astounding. I think Iran produces like 4. There's also more conservation, other things, but right now we do not have an energy crisis, we do not have a natural gas crisis, we do not have an oil crisis. What about China invading Taiwan? Would that be a crisis? Yes, my friends, that would be a really big crisis. By some measures, that would deduct 10% from the global economy. Just to put that in perspective, the great financial crisis deducted about 5% from the global economy. This is not going to happen, and I'll tell you why. This is the Chinese economy in nominal GDP terms going back to the late 70s. This economy hasn't grown this slowly since the early 70s. And I guess that chart goes back to the 50s, excuse me. So what I know, having lived in China, is what's most important to the Communist Party is staying in power and putting a depression on your populace by cleaving your economy off from the global economy could lead to revolution, right? Revolution would be bad for staying in power. So I think that their self-interest is much greater in their interest in trying to capture Taiwan militarily. So I'm taking that off the table. What about a political crisis, right? I mean, in the U.S., aren't we at each other? Watch this. Who in the room's a Republican? Who in the room's a Democrat? Right, exactly, because you don't want anybody throwing stuff at you. So we had Democrats storm the Capitol. We had Republicans storm the Capitol. I mean, are we not at war with each other? I mean, we have, according to the media, a demented communist on the left, and we have a fascist felon on the right, right? There's no way we survive this. right? Democracy is going to fail. This is the end of the United States of America, right? That's what we're told all the time. Well, is that true? Guess what? Ever since, this chart goes back to 1930s, the economy has grown under every single one of these presidents. That includes your enemy, Donald Trump. That includes your enemy, Joe Biden, right? This economy grows because we just pursue higher quality of living as a human population relentlessly. And for those of you afraid of whoever's sitting in the Oval Office, remember this, we do have a system of checks and balances, and by the polling, I can't tell, right, who's going to win the House, who's going to win the Senate. Basically, the margin of error is very slow, which means you're probably not going to get a mandate one way or the other, so you're probably not going to pass any major legislation. And here's a quantitative way to assess all of this. There is actually an economic policy uncertainty index which measures how many articles are being written about economic policy, how many articles are being written about the expiration of tax policy, and the range of disparity in economic forecasts. And right now, that's at the mean. So basically, nothing is happening outside of a whole bunch of political bluster on TV. So my bold forecast for 2024 is that this is not the end of us and democracy will prevail, if you like it. Thank you. Thank you. Taylor likes it too. All right, now let's figure out how to make money. Who in here likes to make money? That does not make you bad people. I just want to go on record saying that. All right, so we've got 3 potential outcomes to consider. 1, will investor returns be less than 10%? 2, are we going to be in the center of the bell curve, somewhere between -10, +10? Or are we going to be at the fringe of the bell curve where we get investor returns over 10%? All right, here's one thing I need you to know. If there's not a crisis and there's not a recession, there is a 4% chance that the market declines more than 10%. There is an 86% chance this market goes higher. There is a 63% chance this market goes higher by more than 10%. Taylor's reaction is she doesn't know if it gets any better than this. She's very excited. All right, election years do have their own seasonality though, so let's talk a little bit about that. In a non-election year, the market tends to rally early in the year, tends to go to the Hamptons for the summer, and then tends to rally in the back half of the year after Halloween, typically. And the market rises 10% on average. In an election year, what you see is the market sort of crabs sideways in the first 5 months of the year while we're going through primary season. And then once we get clarity on that, we sort of accelerate. And then as we get closer to election day, we get nervous, market sells off. After election day, it goes on a run. By the end of the year, during an election year, the market on average is up about 7.5%. Now, for those of you, I know because I get these emails who say, no, there's going to be this huge correction, elections are terrible, whatever. Well, there is some precedent to that. So in an average election year, the market does have a 14% correction, okay, 14%. But once it bottoms, a year later, the market's typically up 24%. So if we end up having a market drawdown, my advice to you, Swiftie fans, is to shake it off. All right, question is what to buy. Now that you're excited, what you gonna buy? Well, last year, all the talk was, and so far into this year, the Magnificent Seven. Do y'all know what that is, right? It's the combination of NVIDIA, Meta, Tesla, Amazon, Google, Microsoft, and Apple, right? And that drove the vast majority of investor returns last year. Most notably, NVIDIA was up 240%. Meta was up 200%, Tesla was up 100%, Amazon up 80%, Google, Microsoft, Apple all up 50% plus, and the S&P was up 25 or so. So, should you just buy those? Well, this is what they looked like in 2022, with NVIDIA down 50%, Tesla down 65%. I mean, Apple did best, down 26%, the S&P was down 18%. If you look at it over a 2-year period, NVIDIA was up 69%, Meta up 5%, Tesla down 30%, Amazon down 10%, Google down 4%, Microsoft up 14%, Apple up 10%, the S&P up 3%. So when you average those out, the market was up 8%. Or, excuse me, the Magnificent Seven was up 8%. If you take NVIDIA out of that stack, it was down 2%. So it really hadn't been magnificent if you look back over a 2-year period. And last year, there were a couple of distinct patterns. Once there were banking issues, people ran into the Mag 7. That accelerated greatly throughout the course of the year, but in the second half of the year, that advance started to stall out a little bit. In fact, in the fourth quarter, small caps outperformed, mid caps outperformed, Mag 7 still won, but it was a fractional victory against the S&P that was up 16%. So is that foreshadowing? I don't know, something to consider. Here's one thing that does support the case for perhaps moving beyond the Mag 7. So last year, there were 500 companies in the S&P 500. Earnings for the Mag 7 were positive. Earnings for the remaining 493 were negative. Stands to reason that people were excited about them. But as we move forward, and by the way, small caps, negative earnings last year, mid caps, negative earnings. As we move forward, earnings are going to broaden. So they're going to broaden across the 493. They're going to broaden down to mid caps. They're going to broaden down to small caps. And in fact, what you should see is earnings growth in these other areas of the market at par, if not above, what we get out of the Mag 7 and large caps. So then it's a question of, okay, if they're all equivalent, what do I pay for them? So right now, Taylor would have to pay 20 times to buy the S&P 500. She could pay 15 times to buy the same earnings growth rate within the mid caps. She can pay 14 times to buy the same earning growth rate among small caps. The last time small caps were this cheap relative to large caps was in 2000, and they went on a 10-year run while that valuation mean reverted. Typically, small caps are valued higher than large caps. During that period, in the first 3 years, the small caps outperformed by 6%. Over the first 5 years, it was 8%. Over 10 years, it was 4%. Lots of opportunity there. Now, I'm not the only person on Wall Street talking about it, which kind of spooks me because that makes me consensus. It hasn't played out yet. What will unlock this value is interest rate cuts. This is really a second half of the year call, but might as well get you all the news early. All right, for those of you who love bonds, I didn't see Duncan in the room. For those of you who love bonds, it's 5% everywhere, right? So congratulations. Bonds are back. You can make 5% on your bonds now. All right, so when we talk about markets in 2024, ladies and gentlemen, it's a love story, right? So I think stocks end up being up 10% or so. Bonds end up getting you your 5%. Money markets are actually going to go down because the Fed's going to cut rates. So they're yielding 5 now. By the end of the year, they'll yield 4 and change. And then if you want to chase a little bit of excess return, I think you lead towards small caps. All right, there's one thing that gives me extreme amount of optimism, and that's the fact that we are in a technology cycle right now with the advent of AI, right? Don't know what AI is. Is it going to kill us? Don't really know. But in the meantime, it is going to create more efficiencies, more intelligence, more margin across the economy. So this is the productivity in the economy. And remember this, the economy is nothing more than how many people are at work and how productive they are, right? So if you can increase the number of people at work, that's good. If you can increase how productive they are, that's really good because that falls right to the bottom line. So over the last 5 years, productivity in the U.S. has gone up about 2.1%. You can see what happened when we brought the web in, right? So the internet boosted productivity to almost 4% annualized. How great was that? Moment of silence, please, for the 90s. Whew. Anyway, so we're getting ready to enter another cycle like that could be even greater. So that gives me even more optimism, which freaks me out. So I need to go back to where this presentation began because what we like as investors is pessimism. And so if everybody on the street is as optimistic as I am, that's a serious problem and requires a rethink. So I went back and I looked at 20 major strategists S&P 500 targets for 2024, and here's what I found. JP Morgan was at the low end at 4,200. Ed Yardeni was at the high end at 5,400. That puts the mean at 4,861. We ended last year at 4,770. We closed on Friday at 5,006, so we're already up 5% on the year. So once again, optimism prevails. It's early, but so far. But it did make me feel better that Wall Street strategists are still pessimistic. All right, here's the thing to leave you with. I'm sticking the landing, Ted. Here's the thing to leave you with. The return distribution curve for the stock market is not normal at all. In fact, you're far more likely to get returns of 20% on an annual basis than you are to get returns from -10 to 10 or even from 0 to 20%, right? So this return distribution is heavily skewed to the right, which means in any given year, the probability is it's going to be better than you think. All right, so here's my bottom line for 2024. Stocks are going higher. I think small caps, it's a second half story, outperform large caps. Growth and value, I don't think it matters. You don't have to get cute this year. Earnings are coming back. Just own stuff. In terms of domicile, international, USA, I think they both work. U.S. interest rates short term are going lower. I'm not sure how much lower they go on the long term, and here's why. The world where we had 1% 10-year interest rates was weird. The world of 4.5% to 5% 10-year interest rates is actually normal. So if the economy can handle a 4.5% interest rate on the 10-year, that's awesome, because those of you who own that bond make 4.5%. So anyway, short-term rates go lower. I'm not so sure about long-term rates. In terms of the U.S. dollar, I think it weakens once the Fed starts cutting, which is good for earnings and good for international equities. In terms of bonds, you're going to get your 5%. Stop worrying about it. In terms of the primary threat, it is inflation. So inflation is the primary threat. It is a possibility. I don't really see it as a probability, which means I do think in the final analysis that we can get everything economically and from a market returns perspective back to the mean. And wouldn't that be kind? Questions? Come on. Thank you.
Channeling your inner Dick Cheney, are deficits and the debt ever going to matter?
So the U.S. sort of had a master plan, and it was that we will grow spending 3% every year above the amount of tax revenue we receive. That would be a 3% deficit. We will run the economy at a 3% inflation rate, right? So if we're running a 3% deficit and a 3% inflation rate, then real debt isn't growing at all. So that was the master plan. It broke. So now we're running deficits of, call it 7%. The inflation rate right now is less than 3%. It does create a problem. And so the accumulated deficits create total debt to GDP, which right now is about 120%. Is that a problem? Seems like a problem, but governments don't operate like people. So US total debt to GDP is 350%, okay? Seems like a lot. Chinese or Japanese debt to GDP is more like 600%, okay? Their interest rates are lower than ours. So the translation mechanism for the debt being a problem is that your interest rates go parabolic like they did in Greece, right? But Greece didn't have the ability to set its own interest rate policy. They couldn't print money. So I talked to Bullard at some point when he was in town, and I was like, so you're just looking at Japan? And we don't have a debt to GDP problem until Japan has one? He goes, kind of. So there's a lot of debt capacity, I think, left in the U.S. Morally, it's reprehensible. The way we're running the economy, is it putting us on the verge of crisis? I don't think so. When Japan goes into a crisis, we're going to have another one of these meetings, and we're going to say, okay, the frontier is at 612% of GDP, so now we know, right? So the U.S., yes, it's running terribly. The deficits are bad. We're spending $1 trillion a year on interest payments. Something needs to happen there. Nobody has the political will to do it. And so therefore, we just have to forecast what the tipping point is, and it's far beyond where we are today. Yeah.
So you mentioned that during the 90s and during the time of the internet, it actually increased productivity. It increased productivity and increased employment. However, with AI, you may increase productivity, but you're not going to increase employment because of actually the contraction of jobs. How is that going to impact, or what's your projection on the impact of AI on the overall opportunity as far as productivity and job growth?
So I had a great economics professor at Sewanee who told me, don't ever be Malthusian. Okay, for those of you who don't know this, Thomas Malthus was an economist who said that the world's population is going to stop growing because we're not going to be able to grow enough food, right? The reality is technology came along, farmers became a whole lot more productive, and we could afford to have a whole lot more people. So I was in a meeting, and somebody asked me that question a different way. They said, Goldman Sachs says that because of AI, 25% of jobs will go away. That's one way of looking at it. The other way of looking at it is we'll have 25% more workers. Remember when I told you the combination of number of workers and productivity equals economic growth? If the US economy suddenly had 25% more workers, that would be an enormous lift. Because our problem right now, and what creates these technology cycles, is not that we have too many workers, it's that we have too few. That's what forces technology to fill the gap, and that's what's happening right now. So I don't really view it, yes, you can hire technology to do financial planning, but you can't have the financial planning you get from Teresa Bailey or Perry Green or Luke or Sean. I mean, there's just the human element still matters. So all it ends up doing is enabling us. I don't think it replaces us. Now, some of the jobs, I think about, and I'll be controversial, I think about STEM jobs. STEM jobs are awesome. How much of that can be done by the AI? I don't really know, right? So we're betting the farm on STEM, and I like that. Maybe the AI enables that. Maybe it replaces some of that. We got to be mindful of it. My son's at Belmont and in the songwriting program, and I saw a guy in Phoenix not too long ago, and he said 70% of the content that you're seeing now, 10 years from now, 5 years from now, will be generated by AI. You'll go home at night, and you'll say, God, I really like House of Cards, and I really like The Terminator. You know what'd be great is if there was a movie that just combined House of Cards and The Terminator, and the Netflix will just have it for you, right? So music will do the same thing. So I said to him, I was like, maybe it's less about sound engineering and more about who gets to be the producer of the AI record. Like, what does that look like? Those questions will be answered. I mean, we will all find our way. And in doing so, we get 25% more workers. I see that as a positive, not a negative. But it's going to create shifts, and we got to be mindful of it. We got to think it through. Yeah.
A number of Fortune 500 companies got rid of degrees as a requirement. And we know that we have blue-collar jobs and white-collar jobs, but the emerging field of new-collar jobs where people can get certifications and earn a great cost of living.
Yeah.
So what does that mean for the economy in terms of Memphis not producing as many college graduates or associate degrees, but we can pivot to offering more certifications that people can go into fields that they can make a great cost of living without having a degree? So
are you recruiting this guy? Because you're 100% right, by the way, 100% right. So one of my biggest issues with the Memphis economy is that we don't do a great job of building the skill set, matching it with the employer, and connecting the tissue, right? I mean, we had this version that everybody needs a college degree. Well, that's great. I went to Sewanee. I got a really good college degree. My starting salary coming out was $14,500 a year, which was right above the poverty line, and I lived in Phoenix and had no air conditioning, right? So had I come out with a welding degree, I would have made $100,000. Right? Which I might have done if I knew you could do that, right? So I think the certification, and we talk about this in the chamber, we need a better jobs university, right? Where you just walk in the door and it's, well, here are the 15 jobs that are on offer. How much money you want to make? Well, I want to make $75,000 a year. Great, we're going to train you to do that one, right? I want to make $125,000. We'll train you to do that one. I don't want to work that hard. Maybe 35. All right, we'll do that one, right? I mean, we need to do a better job as a community of doing that triage function to match whatever the ambition is with the jobs that are on offer, because they're there, right? We've just done a terrible job of that matchmaking. So we need a better jobs university. Yes? Yes. I know. I'm excited about it. All right, anything else? I see a hand over here.
Hi. Given the fact that U.S. dollar, like you said, is weakening, but we also see that China, after post-pandemic, they are economically and as well as on soft power-wise has increased their expand. what is the United States doing on protecting the value of the dollar?
The value of the dollar is really a function of interest rates and global economics, and it's very difficult to forecast. The reason that the dollar is the world's reserve currency is we have the only market deep enough to park real assets, right? So if you're China, and actually they're selling treasuries right now because they're using their money, but if you're China and you're trying to figure out where to put a couple $1 trillion, there's only one market deep enough to accommodate that, and that's the US market, right? And Europe has a monetary union, but it doesn't have a fiscal union. You saw that with what happened with Greece. And so in a world where you have to choose where to park your $1 trillion, the dollar ends up being the best house. In fact, I got an email on this the other day. What happens when they cut the rating on US Treasury debt? Do you know what typically happens? Yields go down. And they go down because that's a signal to the globe that there's risk afoot. And so what they do is they stuff the US mattress. So the dollar ends up being kind of a global risk barometer. Right now it's strengthening, it's weakening, it's sort of, treading water. But once we start cutting rates, people might start looking for yields elsewhere. If they believe in this, they get more optimistic. That might move some money out of the dollar. But there really isn't a credible competitor to the dollar. I don't know how much, maybe we got some crypto fans in here, but I'm not comfortable putting $1.5 billion worth of client assets in crypto, right? So the dollar is just the best house in a bad neighborhood.
Last question, David Waddell. It's me at the mic. Last question.
Good morning. And continuing the conversation regarding the dollar and its valuation, how do you anticipate BRICS affecting the dollar being used as a reserve as well as the currency for most international transactions?
How do I think rates will impact?
BRICS.
BRICS? Mm-hmm. Oh, Brazil, Russia, India, China? Mm-hmm. I spent a lot of time on that. Brazil has some uplift right now. India has a ton, right? So I was in India a few years ago, and I bumped into a JP Morgan banker, and I said, "What are you doing here?" He goes, "We're back." And so India is getting a lot of investment, and the economy's growing, and Modi's pursuing some, prosperity-forward economic policies. Do you really want all your money in the Indian currency? No. Do they really end up being a block? I mean, China and Russia have a love-hate relationship, and there is some economics happening there, but there were people that were saying, there's going to be this economic or this currency block that comes together, and those are very different countries. I mean, China is very different from Russia. India and China don't get along. They have skirmishes on the border in Kashmir, and Brazil is essentially a grocery store. Right? I mean, they just make vegetables and stuff, some oil, and then every once in a while a technocrat will steal all the money. So it's not, I don't think that ends up being a credible threat going back to, if not the dollar, then what, right? So I don't think those end up being a credible threat. I do think they create political threats, and I'll stop with this because it irritates me. So I was in China the moment that the United States changed its policy towards China to containment. Now, if I said to you, my policy towards you is containment, how would you feel about that, right? I mean, it pissed them off, and it should have pissed them off. And I saw Bush and George Clinton speak together a couple weeks back, and they were asked about China, and they said, we need to shut up. Like, we need to stop talking about Taiwan. We need to stop saber-rattling with China. Like, we need to be in a world where we coexist. So the U.S. is not blameless in creating what has become a coalition among the BRICS. We got policies that are good. We got policies that were bad. We change presidents a lot. And so there's a lack of policy continuity. All that to say, I think we've created some problems by pushing those countries together, but we're still the reserve currency, and it's not going to hurt the dollar. Sorry, soapbox.
Thank you, David. Allow me to close us out with a few announcements. I got to say, what a great morning it was for Memphis and this Chamber of Commerce. By way of introduction, my name is Don Bradford. I'm CEO of Memphis-based InSafe. We are an environmental safety, health, and engineering consulting firm with nationwide offices. Tecora, let me just say your presentation, although brief, really resonated. Thanks for bringing those points on the research and analytics that your team is doing, and really glad to have you on Team Memphis. Looking forward to have you advance based on the data. And David, what can I say? A true treasure of Memphis. Everyone in this room recognizes it takes a lot of ingenuity to incorporate Taylor Swift in an hour-long presentation. It takes a little bit of guts just to have the notion to do so in the first place. So glad you go into that mine for the week and what you come out with. I know I don't speak alone. Surely others felt it, but admittedly, when I walked into breakfast this morning, I was questioning how in the world is David going to make Taylor Swift still relevant? I mean, it's been 8 days since the Super Bowl, after all. I didn't think we'd be hearing about Swifties until NFL preseason, but you managed to do it. Great job. A few announcements for the Chamber. First of all, Ted mentioned in his opening comments that tomorrow we have, get this, a record number of this group who will be attending MEM to NASH in Nashville. This is a time where we bring business priorities of our region, West Tennessee and Memphis, to legislators, the governor, and his cabinet. Great to see such a large contingent. I kept thinking, David, you might even introduce Taylor, but Ted, I heard she's on her way to Nashville to represent Memphis as well, right? Chamber at work. Next Wednesday afternoon, February 28th, Chairman Circles investors, please join us for the Workforce Task Force meeting at Regions Bank. Learn how you can empower the amazing young people in your company in just a few minutes a week by using a new digital platform. That's got my attention. Looking forward to seeing everybody next Wednesday. And then finally, if you haven't already RSVP'd for next month's Why Memphis Chambers event, it will be at the FedEx Event Center in Shelby Farms on March 5th. And what we're going to be doing is we're going to focus on expanding the narrative when it comes to telling the Memphis story. You're asked to bring 2 of your top team members and be prepared for a data-driven, informative celebration of our accomplishments, economic progress with and through the Chamber. See how your Chamber of Commerce is moving things forward. What a great day for Memphis. Thank you all to our speakers and for all of your participation. Have a great rest of your day.